Welcome everyone to this Wednesday edition of Inside India. I'm Sri Jegarajah. Here are your headlines. President Trump sets 19% tariffs on Indonesia as he continued to tease a potential trade deal with India. Indian auto sales hitting a speed bump with quarterly numbers falling for the first time in 2 years as Tesla launches in the country. And WeWork gets the nod from Indian regulators to list in the country as the US co-working space builds momentum overseas post-bankruptcy. Welcome to the programme. Indian markets will be joining us in about 45 minutes' time. Let's give you Gift Nifty futures. And what they are indicating is 25,176 at the open. Yesterday was an interesting session for the market because Indian stocks did snap a 4-session losing streak after inflation came in lower than expected. So this continues to be a favourable catalyst for the broader markets and does boost expectations of more RBI rate cuts. Let's give you the currency as well while we're at it. Dollar India rupee exchange rate at 85,981. Broader markets in Asia, we're seeing a wide degree of dispersion here. I wanted to highlight the TAIEX at its highest since late February. On the other side of the ledger, Philippines, the lowest since late June. So interestingly enough, there seems to be a conversation now about tariffs possibly leaking through to the data. Inflation was a case in point. We are witnessing rising US Treasury yields, and of course it was a mixed picture for US bank earnings. Let's get more on the data. Some concerns about inflation creeping higher after US CPI data saw its biggest rise in months, paring back expectations for lower rates soon. Consumer price inflation in June rose 2.7% on an annual basis. That was above expectations and the biggest rise in nearly 6 months, and a sign President Trump's tariffs were starting to bite. And with just over 2 weeks to the August the 1st tariff deadline, President Donald Trump says more letters and deals are on the way. Indian negotiators are back in Washington to push talks forward. President Trump says the US will open up India, just like it did with Indonesia.
Indonesia was great. He's a great president. And we made a terrific deal where they opened up the entire country to trade with the United States. We weren't allowed to go in and trade. I think something similar will happen with I would say, India. And we have a couple of others. But I have to tell you, for the most part, I'm very happy with the letters. You know, the letters are a deal.
Meanwhile, NATO is backing President Trump's push for tougher sanctions on Russia. NATO Secretary General Mark Rutte met with US senators in Washington and warned that buyers of Russian goods could face 100% secondary tariffs.
Listen, if you are the president of China or the prime minister of India or the president of Brazil, and you are still trading with the Russians and getting the oil and the gas in, and you sometimes even resell it for a higher price, know that if this guy in Moscow doesn't get serious about peace talks, I will slam secondary sanctions on you of 100%.
As we mentioned, Indonesia, the largest country to get a trade deal with the US. JP Ong has the details on that and joins us now. JP, Indonesian stocks and the rupiah are rising modestly after this news. Does that imply that Indonesia can live with a 19% headline tariff?
It seems to be the case, or at least it provides some certainty, at least, with regards to what the number is, and it lets business leaders and economic officials in Indonesia at least get on with things and plan or adjust around this 19% tariff. And as we know, Indonesia actually wanted, Sri, to get a better deal in Vietnam, and it's 1 percentage point lower than what Vietnam actually achieved. At 19%, it's actually pretty decent. Also, it means that Indonesia's efforts to try at least make that full court press and offer that $34 billion purchase order, at least, of additional U.S. imports actually worked this time around. It seems this was also confirmed by President Donald Trump when he said that Indonesia is indeed committing to buying more than $15 billion worth of U.S. energy goods. This was also confirmed by Indonesia's state oil agency Pertamina that said they are working on MOUs to acquire agricultural feedstocks and also crude oil from the United States as part of these deals. They're talking to the likes of Chevron, for instance, out in the U.S. with regards to those purchases. There's also a deal to purchase up to about 50 Boeing jets for the Indonesian flagship carrier Garuda Indonesia. This was also corroborating the claims of Garuda Indonesia's CEO, who said that they could buy up to between 50 to 70 jets. So all well, at least for Indonesia right now. And as we mentioned, Sri, the Indonesian Jakarta composite is rising today's session. There's another possible driver actually for the gains, at least we're seeing for the Jakarta composite, and that's because later this afternoon the Bank of Indonesia is set to make their decision, and many economists are expecting that they will cut rates by about 25 basis points. So you have another monetary policy booster for the Jakarta stocks right now, and you also have news of this trade deal that creates some certainty, at least for some of these business leaders in Indonesia. So suddenly you might see that the Jakarta composite could make it 8 straight days of gains and sustaining that breach of 7,000 so far in today's session. We'll have to watch out for that policy rate differential with the Federal Reserve because it will narrow to about 5.25%. But again, we'll leave it to Governor Periwarjo to make that decision whether or not they will cut. But expectations are that they indeed will trim that policy rate today, Sri.
It really parallels discussion and the narrative in India. And we know that there was probably some finessing going on with agriculture as it is in India. In Indonesia, a very domestically sensitive area. So this provides something of a playbook for India, I would imagine. JP, thank you very much indeed for that. Right, no trade deal yet, but India's exports to the United States are already rising, jumping over 23% despite higher tariffs, reaching $8.27 billion in June. Overall, merchandise trade deficit did narrow last month as imports dropped sharply, exports hitting a 7-month low. Deficit stood at $18.78 billion, lower than expected. Crude and gold imports fell, helping improve the trade gap. Narrower deficits could help the Indian rupee. And Nvidia CEO Jensen Huang is in China speaking at the China International Supply Chain Expo. Let's listen in.
Once hand-coded and now ran on CPUs. Now AI learn from data and runs on GPUs. This shift from human-coded logic to machine-learned intelligence is resetting the chip and computer industry from the ground up. In 2016, we introduced DGX-1, the world's first AI supercomputer. I personally delivered the first one to a small, unknown startup in San Francisco, OpenAI. Since AlexNet, from our Kepler architecture to our new Blackwell architecture, NVIDIA has advanced AI computing through chips, systems, networking, and algorithms by 100,000 times. 1,000 times faster than Moore's Law. Today, NVIDIA is the computing platform that powers the global AI ecosystem. AI is transforming every industry, from scientific research and healthcare to energy, transportation, and logistics. AI powers iconic Chinese platforms like Tencent's WeChat, Alibaba's Taobao, and ByteDance's Douyin. AI drives Xiaomi's autonomous vehicles and smartphones. AI enables Baidu's AI search and Meituan's super convenient delivery service. And AI powers InfoVision's medical imaging diagnostics that improves healthcare in over 220 countries worldwide. The heroes of China's super fast innovation are your researchers, developers, and entrepreneurs. More than 1.5 million developers in China build on NVIDIA today to bring their innovations to life. Models like DeepSeek, Alibaba, Tencent, Minimax, and Baidu ErnieBot are world-class, developed here and shared openly, have spurred AI developments worldwide. China's open source AI is a catalyst for global progress, giving every country and industry a chance to join the AI revolution. Open source is also key to AI safety, enabling international cooperation on standards, benchmarks, and safeguards. Today, AI is fundamental infrastructure, like electricity and internet before. AI is revolutionizing the supply chain, changing how we build and move things. Hundreds of projects in China are simulating digital twins in Nvidia's Omniverse to design and optimize factories and warehouses. And robots are trained inside Nvidia Omniverse, the virtual worlds, to work safely alongside people in the physical world. The next wave of AI is robotic systems that understand the physical world, reason, and perform tasks. Within a decade, factories
Jensen
will be
Huang
powered by
speaking
software
in
and AI.
Beijing. Let's get out to Elaine Yu, who has been tracking all the buzz surrounding Jensen Huang's trip to China. Elaine, it's clear that Jensen is proving that tariffs and the chip restrictions are no obstacle. Is the China market wide open for Nvidia, or do challenges still remain?
So he is, coming, this timing of this trip is when the U.S. and China are hashing out this tariff deal, right? And he's threading a thin needle here. He was lobbying with Trump and also now speaking with government officials, industry officials in Beijing. And this is a time when AI chips are the new bargaining chips in a sense. And it's not just AI, but with rare earth being part of the trade deal, we're really seeing a new reality of critical technologies and AI rare earths being deeply entwined in geopolitics. And we are seeing strong demand from Chinese companies for these H20 chips. So that shows that Nvidia can still count on its revenue exposure to China for the time being. And here it's interesting that Huang isn't just the tech executive. He's also playing this diplomatic role here, a bit threading that needle between the two powers. And he wants to tap not just China's lucrative market, he wants to tap China's AI researchers and AI talent as well. And he said that access to China is important because if China's AI talent used Nvidia's or the American technology stack, that could really bolster America's global clout in terms of AI, and it could be a springboard for other markets as well as it comes back to China. So for all this talk about U.S.-China rivalry, China's technological self-sufficiency, the tech world is still wanting these bridges. It's just that it's all now tied up with geopolitics. Sri, back to you.
I like what you said about diplomacy, and he's a master of localization, isn't he, Jensen? It's interesting that he swapped his classic leather jacket for a classic Chinese-styled tunic. DeepSeek, clearly not a challenge, but an opportunity for Nvidia. Elaine, thank you very much indeed for that. Coming up, we will take it back to India and talk about the auto story. Stay tuned for that conversation. Welcome back. Tesla has finally opened its first experience centre in India, but there are multiple tweaks to its Model Y made for the Indian market. CNBC TV18's Parikshit Luthra was at the opening ceremony and filed this report.
Tesla has launched the Model Y here in India. The starting price for the rear-wheel drive is around 61 lakh rupees, inclusive of GST and other local taxes in Delhi. This gives you a range of around 500 kilometers in a single charge. The long-range version, that would cost you around 69 lakh rupees, inclusive of GST in Delhi. This would give you a range of around 622 kilometers in a single charge. In terms of performance, the top speed of the Model Y is 200 kilometers per hour. It can go from 0 to 100 in 5.6 to 5.9 seconds. A lot of new features. This is a redesigned latest Model Y that has been launched in Mumbai. What do you get with it? Well, you get a new front lighting. You get 8 cameras. In fact, the latest camera has been installed in the front of the car. It has a self-cleaning function as well. You've got new air ducts to reduce the aerodynamic drag of the vehicle. New aerodynamic 19-inch wheels with the Model Y. You've got a crossbar tail lamp also at the back. 2,130 liters of storage space. 15.4-inch touchscreen for the driver and those sitting in the front row, an 8-inch screen for those sitting in the second row of the car. This is a mid-size compact electric SUV that will compete with the likes of BYD, VinFast, Mercedes, BMW, Audi, and also local car makers like Mahindra Group and Tata Motors. It's going to be very competitive, not easy for Tesla. They're going to launch a second showroom in Delhi very soon. They have a charging plan. They'll have 4 charging centers in each city, that is Mumbai and Delhi. Around 16 superchargers and 16 destination chargers in each city as well. So currently they're launching in Mumbai, Gurgaon and Delhi, but very soon they could have a plan to launch in more showrooms across the country as well.
An elegant and comprehensive report from Parikshit despite those unpredictable Mumbai rains. Now, while Tesla tests the Indian market, overall auto sales are losing speed. Between April and June, vehicle sales fell over 5%, according to the Society of Indian Automobile Manufacturers. Passenger cars, the biggest laggard, with sales down more than 11%. Two-wheelers as well did not find many takers, registering a drop of 6.2% as consumer demand cools. The industry body SIAM is overall cautious going forward and hopes the festive season upcoming will bring some cheer to the market. Let's get more on this. Bring in Saket Mehra, partner, auto and EV industry leader at Grant Thornton Bharat. Saket, welcome to the programme. Your take, why did India's passenger vehicle and two-wheeler sales fall in the June quarter? That broke a 4-year growth streak. That's not really consistent, is it, with projections for an economy that ought to be growing in the region of 6.5%?
Yeah, so absolutely. If you look at, I would say FY 24-25, we had a moderate growth of almost 7.5%. And depending upon whether it's passenger vehicles, two-wheelers, every segment grew. We also saw a very significant jump in the exports potential, which India really has, both from a passenger vehicles as well as two-wheelers. To your question in terms of what really happened in Q1, I think we also need to understand that auto, or it's an aspiration buy for the Indians. Typically, if you look at in Q1, there was some pressure with respect to the raw material. There was some pressure with respect to the global tariff, or for example, the geopolitical issues which really impacted. So what really it led to some kind of a margin pressure on the component players as well as on the OEMs. As well as from a demand side, generally Q1 is slightly lower as compared to the next quarter, which is the start of the festive season. And typically it goes till Q3. So it's pretty normal as, we are very optimistic in terms of the demand picking up in the subsequent quarters.
Yes. So it's interesting that Tesla are catering towards the luxury premium end, as is Mercedes, which had a record Q1 sales. But luxury is just 1% of the overall Indian car market. What then is holding back a mass market push?
So I would say it's the rural demand largely which is pushing us back. We have seen some kind of a dip when it comes to semi-urban as well as the rural markets. That's one. Interestingly, the Union Budget 25-26 had very lucrative provisions as far as the personal taxes are concerned, which ideally should have led to more growth in the sector, which hadn't picked up in Q1. But as far as the luxury sales are concerned, or the luxury car sales are concerned, I think India happens to be one of the fastest growing market. And we have seen the numbers as to how the luxury car market has grown in India. And more importantly, the EV, the luxury EV market is also a very big potential. And that's why we see companies like Tesla now coming in or making their presence and giving us stiff competition to the existing players as well as the potential players.
Saket, any thoughts on what was behind the 6.2% decline in two-wheelers when typically we count on that market segment to be to deliver consistently solid results? What does that tell you about macroeconomic conditions?
So largely, I would say two-wheelers, it's a very, very price-sensitive segment. If you look at from a regulatory standpoint, there were these regulatory provisions with respect to onboard diagnostics, or, for example, making sure that, yes, these features are enabled in all the two-wheelers, which led to some kind of a price hike in the vehicles. Second is more in terms of the demand coming from the, as I said, from the semi-urban and the rural areas. What really impacted India bad was the unemployment rate, a very, an increasing unemployment rate, which typically impacted the two-wheeler sales to a very large extent. Though from an overall macroeconomic standpoint, we are still at a better position in terms of the inflationary kind of the growth, which is very much in control. But what's impacting and what's really holding us back is the unemployment rate. So that's one of the possible reasons for a dip in the two-wheeler sales.
It wasn't all bad news, though, was it? What drove that 3.8% increase in growth in utility vehicles? And that lifted the market share for that segment to 2/3 in the overall passenger vehicle segment.
Yeah, so utility vehicles, if you look at now, command roughly around 65% share of all the vehicles, all the passenger vehicles which get sold in India, which is up from 60% of last year. I think what is really driving this kind of a significant shift in the consumer behavior is the fact that Indian consumer is very sensitive, is very particular about the features and the options available to them. Many of the Indians, many of the millennials or the Gen Z are typically more inclined towards using vehicles for not only for their office commute, but also for a larger person commute. So the weekend drives and also making sure that, yes, they have opportunities to kind of explore the newer territories near to their places is really pushing up the utility vehicle sales.
Understood. Saket, how challenging is the supply side for the auto industry in India? And are tariffs, access to rare earth minerals as part of the auto supply chain, how problematic is that? And how are manufacturers navigating these challenges?
Yeah, I think let's accept that it's a challenge because we still rely a lot on the external supplies of these critical materials, be it the rare earth magnets or the other components. And these items play a very significant role in terms of manufacturing sensors, semiconductors, even the steering parts, etc. So there's some kind of an impact. But what's really helping us as a market is the seriousness which the Indian government is kind of demonstrating with respect to having its own rare earth mineral policy, making sure that, yes, we kind of identify the sources, the alternative sources, and not really remain dependent only on one single country for supply. So I think all the, what we have seen in the recent past, the free trade agreements with most of the nations that India has signed will go a long way in terms of ensuring a very consistent and a sustainable supply chain.
Saket, yesterday, Vivek Vadia said that it's those names who have access to EV battery technology that ultimately win the race. I want to play that soundbite for you, and then we will get your response. Here's Vivek.
Unless you have the entire battery and related value chain, like the lithium, the minerals that are required to build the battery, I won't call it a winner. Even if you manufacture like 10 million cars and just assemble and sell, ship out of India, my question would be where the battery is coming from. And if it is not coming from India, then what have we achieved?
Saket, so what's being done to scale the manufacturing of domestic EV batteries, and who's leading in this critical segment?
Yeah, so I would say it's evolving. This industry is evolving. I wouldn't say that, yes, we have reached where we should have been, considering the fact that the Indian government had been having a vision to move towards electric vehicles many, many years ago. But yes, we are seeing some traction, particularly in the battery cell manufacturing space, both from the manufacturers as well as the institutional investors or the foreign direct investors who are particularly keen to look at India as a market. If you look at the Q1 and Q2, the deal share or the of the overall market investments which came to India, there's a significant amount of investments which came in this particular technology. If you look at from the government side, again, there's a lot of incentives which are being rolled out by the Indian government, for example, the advanced chemistry cells. I think all these regulatory push as well as the interest which the Indian manufacturers are giving to the global investors, we will see a light very soon as far as the battery manufacturing is concerned in India.
Understood, Saket. We'll leave it there, sir. Thank you very much indeed for your analysis and insights. Saket Mehta there from Grant Thornton Bharat. We're back in 2 minutes with more on the Indian market. Stay with us. Welcome back. Let's just recap the Asian markets. We are seeing a broad dispersion. We've got the TAIEX, which is leading on the other side of the ledger. Philippine stocks have been weaker, as are Australia and the Kospi. So the narrative is really about tariffs still, and the tariff impact leaking into the data vis-a-vis the inflation numbers that were released stateside yesterday. Treasury yields have been rising, and of course we're in the early stages of the earnings season unfolding with the S&P earnings and the banks kicking off. It was a somewhat mixed picture there. So a lot of moving parts for these markets to digest. Back to India. The unemployment rate held steady at 5.6% in June thanks to stronger jobs growth in rural areas, but urban India tells us a different story. Job creation and consumption remain weak. Unemployment in the cities edged higher to 7.1% from 6.9% in May, signalling ongoing sluggishness in urban jobs markets. Right, we're counting down to the market open in India, and this is how we are shaping up. By the way, yesterday was an interesting session because we got inflation data that was more favourable than what the market was expecting. So that's boosting the idea that we are going to see more accommodation and more rate cuts from the RBI. So that's a very positive catalyst for the markets that led yesterday to the benchmark breaking a 4-session losing streak and was positive yesterday. Nifty futures are signalling 25,174 in the open, so some consolidation expected for the benchmark. Dollar-rupee exchange rate 85.98. India's inflation, as we've been saying, has been on an easing trend, cooling off to multi-year lows and raising hopes of another rate cut by the RBI. CNBC TV18's Lata Venkatesh spoke to the RBI Governor Sanjay Malhotra about these expectations.
MPC has decided to change the stance to neutral. And so what this means is that we can go in either direction. It gives us the flexibility to move upwards or downwards depending on how the outlook, more importantly, rather than, the current data, which we have, now only for Q1. Rightly, you have said that it has come down. But how is it going to look like going ahead? And, we do our own internal assessments. Whether it will be 3%, I really don't know, because those calculations we are still in the process of doing that. We will certainly come out with our latest projections. And the MPC, as always, will factor in the evolving situation, the outlook, and then therefore, take a call as to whether the economy really needs what kind of a policy rate it needs. If the inflation is lowered, the forecast, therefore, the outlook is lower, the growth is lower, certainly, the policy rates can be cut, but that is something that we have to wait and watch.
Okay. What is the trigger for a rate cut? Will it be more lower inflation or will it be lower growth?
It's a mix of the two. It's a mix of the two, really. One can't really say that it is inflation which is more important than growth numbers. For us, as you are aware, it is primarily we look at price stability. That is our core mandate. That is the primary objective. And then we look at growth also. Both are equally important. And I would not say that, we would give more emphasis as of now to either numbers. We also need to be aware of the composition of the inflation, and especially when I say composition, I mean the momentum and the base effect. Of course, core and food is another way of looking at it. But how is this inflation going to look forward in future? That will be more important rather than the 2.1% or the current inflation that we have.
In the IPO space, a shared office space provider WeWork getting the regulatory nod for its Indian IPO. The Indian franchisee of the US-based firm filed draft papers back in February. The offer won't issue any new shares. Instead, over 43 million existing shares will hit the market. Real estate giant Embassy Group plans to offload 33 million of those, making up the bulk of the sale. Right, let's get more on the macro and the market outlook for India. I'm delighted to say a good friend of our network, Hartmut Issel, is joining us now, head of APAC Equities and Credit at UBS Global Wealth Management. Hartmut, welcome to Inside India. How would you characterize, first of all, the balance of risks and opportunities in the Indian markets, and how should that inform the investment playbook and allocation in the second half of the calendar year?
Yeah, and we're quite positive. We call it attractive. This is one of the equity markets also globally and also here in APAC that we have on attractive. Some investors still call about trade and trade tariffs and all these things. Right? I think that's more or less in consensus now. So unless something really, really unfortunate happens, that shouldn't be a driver. The driver is really the earnings side, right? So we're coming from mid-single-digit earnings last year now into what we have calculated 2 years of double-digit earnings growth, slightly over 13%. If you get that and you're early in that phase, you want to be in that market. In terms of risk, I don't see too many. So I mentioned, tariffs, but if anything, right, it's perhaps not so much the reciprocal or country-specific ones. Right? We think they're sort of in the last innings of getting some sort of agreement. So you could argue, okay, what about cars? But I mean, cars on the product side, that's global, right? And so is pharma. But pharma is, in the India context, is still give and take, depending on the index you look at, maybe 5%. So it's not a very large sector. So even there, it's right now it's a bit difficult to see. We already know about a lot of risks that happen. So, I think the coast is clear for more upside.
Let's bring in the RBI and let's bring in the sector-level conversation. Nifty Bank sub-index has had a strong run year to date, largely due to the front-loading of repo rate and cash reserve ratio cuts by the RBI. Is that going to continue to be a positive driver for the financials? And how are you approaching that space?
Interesting part is, so we're positive on India. We think 6, possibly 7 out of 10 sectors that we cover in this space shows us for the current financial fiscal year that has just started, shows us an acceleration in earnings. Right? Interestingly, financials, so including the banks, is not necessarily one of them. That is a story for next year, and also fiscal year 27. Right? So why is that? Because on the one hand, you could argue, okay, what about loan growth? Right? We think it's clear, right, with the rate drops and all these things that we had, right? So that is a matter of time, and we're already seeing maybe first signals that the loan growth side is coming up, and that's for any bank on the planet, that's a positive sign. But then we have also an APAC, and we have different markets or different market systems, right? So in some systems, a lower rate immediately falls right to the bottom line. India, it takes a little bit longer, usually a few quarters, right? So right now we're still probably not, at least at what we think, not fully finished on the RBI side. There'll be more rate cuts. Now, what then happens is that it immediately floats to the lending side, but not immediately to the deposit side. Although we see in this cycle it's a bit different, right? The Indian banks, we see them also do something here. But long story short, what it does mean is typically your margin, your net interest margin, first comes down a bit, and we're seeing that already to some extent. So we need probably 2-3 more quarters until that is over, and then you have 2 strong drivers next year. Right? So when is next year? Right? It's to take maybe 6, maybe 8 months. So then you have that sector really standing out. Very interesting.
So does that imply, Hartmut, that you are relatively cautious in the here and now before we see that push higher in the financials next year? And is that down to concerns in areas like auto financing, concerns with microfinance and unsecured credit? This has been something of a challenge for names like HDB. They've been talking about that. So just how cautious are you in the here and now towards the financials?
Last year it has been, right? But I think even on the unsecured side, right, it's sort of starting to bottom. Also the portfolio mixes, etc. Right? And otherwise you have, if I look at just the macroeconomics, right? So we had tax cuts, or at least on parts of the population, right, from the February budget, right? So we have a couple of areas, and not least, right? Early next year, the 8th Pay Commission is coming up, and it's not small, but it comes only every 5 years. And so you have, right, first typically the central government, and then afterwards the states, right? So you have salary increases as well, and these are not small, right? So we reckon over 2 years, that's a time period, slightly over 1% of GDP. I mean, if you count all these things together with lower rates, I find it difficult not to be positive on the bank side.
Are there growth concerns, though, lurking in the woodwork? And is India's macroeconomic picture really that sound when you consider we've just had relatively subdued quarterly earnings, June quarter passenger vehicle and two-wheeler sales. We were just talking about this, which are bellwethers of the economy. They fell, broke a 4-year growth streak. Does that imply, perhaps, Hartmut, just modest returns and no sustained rally this year in the markets?
Yeah, here's how I see it. Right? So we look at the last 4 quarters, the ones that have already passed, right? And as I mentioned, according to my numbers, we maybe close to 7%. I mean, a single, not negative, but a single-digit growth, and doesn't happen very often in India for that part, right? Because he also came from a high base, right? Yes. So on our numbers, it came from 25% growth in the Nifty. And yeah, it's clear, right? No index can keep that up for a couple of years. So now you have a low base, right? The year before you had a high base, so almost 25%. Now you have a low base. Right, so that alone, I think, makes it easier. But yeah, the macro side, I mean, falling rates, right, loan side coming up again, is difficult to argue. You shouldn't look forward 2-3 quarters and think what will happen then. It's very difficult for me to argue that the earnings growth will stay where it was. It has to come up. It has to come in double digit, in my view.
Global funds have always had a bee in their bonnet about valuations in the Indian market. So how would you characterize valuations right now? How are they coloring foreign and domestic investor participation? At a sector level, where are they most elevated?
Yeah, I wouldn't completely dismiss that, right? So we hear that also a lot from our clients, from our investors. Right? What about the valuation? So on the Nifty side, where it's slightly over 20 times already, isn't that high. Now, I'll give you 2 arguments why I wouldn't worry too much about it, right? So one is purely performance, right? So we did an exercise also last year, right? So over the last 25 years, right? Which markets have performed? Of course, the US stands out, but there's not so many other markets who at least are close to that, even in dollar terms, and India is one of them. Right, so if India is sort of on a valuation, the US is also not particularly low in terms of valuation, right? If that's the case, but you can rely on the earnings growth, maybe takes the concern a level down, right? And the other part that I think gets often forgotten, of course, your PE, so your valuation, is supported when you have falling rates, right? So let's take the 10-year view in India, right, for the Indian government bonds, right? So right now we're at 6.3. They have already come down. We see them below 6 middle of next year, and when that happens, that's another 0.4 percentage points. Why would all of a sudden valuations drop? So, I understand the argument. I'm not saying it's particularly cheap if you look at other markets, but with you're in the early stage of an upcycle in earnings, yes. And valuation, from a rate side, should also not work against you.
But you've lived in India. You lived in Hyderabad, in India's Silicon Valley, so to speak. So how would you approach the IT services? We have to be very selective, especially those that have exposure to the US and the North American markets at this time of pronounced global growth concerns.
Yeah. There are interesting new ones coming up, I will say, but of course, as investors and for the global space, also we look at more the ones that we're all familiar with, especially the top 3 maybe, etc. And yes, it is true, right? I mean, they're Indian companies and have a lot of workforce there, but compared to pretty much all the other companies, right, they have an unusually high revenue part, both in the US and then to some extent also in Europe, clearly, right? So right now, and that's what we're seeing also in the numbers, right? Everybody holds back a bit the investment side of things. So I wouldn't necessarily be extremely bullish, but I wouldn't completely rule them out either, because in the second half, right, when, I mean, most of the tariff talk's done, right, and you have more and more deals, etc. I mean, some of that investment also comes back, so you can see a bit of a rebound. I wouldn't completely write them off.
Let's bring in SEBI versus Jane Street and the market implications of all of that. And it has already hit options volumes and reportedly NSE's pre-IPO valuation. This clearly tells us that the retail crowd perhaps didn't know what they were getting into, were overexposed to derivatives trade. And do you feel then that this is a shakeout that has run its course, or are more skeletons going to fall out of the closet?
Yeah, by the way, we also notice from other markets, right? Sometimes where you see a bit of overheating in some pockets, you will see a response from the regulator, and it's their job to do that, right? Because what they're interested in is a multi-year period where normal investors, right, they can make money, etc. And when there's a little bit of hot pockets here and there, they'll take action, right? So in my view, that's also what we're seeing here. And if you're an investor, even over 12 months' time, right, I wouldn't worry about it for now.
How are you approaching pharmaceuticals, that corner off the market, especially given exports could be in jeopardy after President Trump announced 200% tariffs on that area? And how is that corner of the market and that segment going to price all this uncertainty?
Yeah, that's very true. On the one hand, this is the product tariffs, right? So not the reciprocal ones for the country, but product tariffs, right? And from all that I understand, right, towards the end of this month, we should find out more from the US side how exactly it gets structured, because they said 12 to 18 months, right, there'll be tariffs up to 200%. But we have to, as an investor, also consider, right, that there's two buckets of healthcare, if you will, right? So one, probably not so much in India. There's the actual drugs under patents and everything, right? You have oftentimes very, very high margins, etc. So in generics, for example, also in India, right, give and take, right, 15% is much lower compared to the other bucket. And yeah, if the US comes with tariffs like that, or let's say even 25%, but you hardly make a profit, right? And of course, the argument from the US side will be then you invest here. But we looked at it, right? Even the cheapest cost factor in the US when you produce these generics is 1.7 times. Everything else will be higher. So it raises a bit of a question mark. So whether it comes or not, we have to see. But yes, our view on not being so positive on pharma or healthcare in general in the market, Nifty, is not so much that, right? We'll see, because you could even argue, well, if everybody gets these tariffs worldwide, but then of course the India production is relatively good from the cost side. You don't even have a disadvantage. Possibly you have an advantage, right? For us, it's more, we think in terms of also when you look at the cycle, the pricing, the volume growth, that in the major market comes down a bit, and that doesn't make us so positive on this particular sector.
Understood. Another sector that is very exposed to the tariff narrative in India are the automakers. And it's quite clear that India does want to protect this area of the economy. But from a economic point of view, we've seen some weakness in the latest quarterly numbers, especially in two-wheelers. We were talking about that. How are you approaching this particular sector that is vulnerable, but at the same time is geared to such strong growth prospects potentially in the longer term?
This is one of the examples of a fairly secular sector, right? Whether you take trucks or whether you take two-wheelers or motorbikes or you take the four-wheelers, it doesn't matter, right? They tend to have their cycles.
Yes.
Right? And the last up was basically post-COVID, right? So they were on both sides, right? You've seen pretty strong volume growth. And whenever you see this, there will be a period of several quarters, it's not 1, 2 years or so, right? When things flatten. And I don't think this period is completely over. That's my reading of things, right? So I'm not saying that there's anything wrong with growth, but the cycle had peaked and you're just behind it. So when you really want to be very, very positive on this particular sectors, which I mean was sort of neutral and not particularly positive, probably have to wait a little bit, until maybe the bottom is reached in a cycle, and then you look again.
Do we still bet on the Indian consumer and FMCG, given the premiumization, given quick commerce and all those trends are ultimately going to work in the favour of the Indian consumer, especially in the rural economy, which is really looking quite robust, if not resilient to otherwise slower growth prospects elsewhere?
Yeah. Now that is true, and I mentioned, right, so yeah, certainly some of the tax cuts, right, or the pay commission, right, so there are,
right.
I mean, tax cuts behind us, but pay commission is yet before us, right, and it's as I mentioned, it's not a small number, but we have also seen, I mean, many of these names haven't performed so well also in the previous, let's say, 4 quarters or so, right? And also what you had seen is actually more competition, right, so you have some are also private players that are actually attacking, many things like ice cream, etc., right, on the food side, on the beauty side, right? They're attacking. And now we're seeing slowly but surely, I mean, not saying that everybody will necessarily be going out, right? But we're seeing also these larger companies starting to get a better handle of, okay, how can we respond to that? So from last year, when you had actually fairly subdued earnings growth and, staples, partially in the discretionary side, it's starting to come back, we think.
A final question. Do you feel rupee appreciation is going to be an issue for flows and for perceptions towards the Indian market? And where do you see the benchmarks ending the year?
Yeah. So for rupee, we think compared to other Asian currencies, let's say, right? So yes, they'll probably also appreciate. I mean, you have probably, we think, 4 rate cuts over the next 12 months or so from the Fed, but in RBI, we just heard also the interview where we think 2, possibly 3, but in any case fewer than what the Fed will do, right? So oftentimes when that happens, you can have a little bit of appreciation. Also, on the other hand, since there's a still current account deficit, right? So probably not as strong as for the other Asian currencies. So if rupee goes, and we think 85, maybe mid next year 84, somewhere there, is not a big change. So probably I would really look on the fundamentals on the earnings side and see, is that really working out? And that's probably the best focus area.
And very quickly, Hartmut, if I can press you, can we end the year at around 26,000, or do you think the animal spirits are going to be a little bit contained for the Nifty 50?
I'll stick my neck out. Right? So what was the all-time high? Right? September 26, over 26, right? And we're going back to double-digit earnings growth for 2 years. I think at least 26 we should see at that point.
All right, we'll hold you to that. Hartmut, great conversation. Thank you very much indeed, sir, for joining us on Inside India. Hartmut Issel from UBS Global Wealth Management. Right, speaking of which, Indian markets have joined the trading day. We'll look at some movers in Mumbai after this short break. Back in 2 minutes. Welcome back. Let's bring you up to speed with the benchmark Nifty 50 and the action there at the early open. We're not quite seeing a post-favourable inflation data bump on the Nifty 50. We're seeing a little bit of give back. Let's call it consolidation around this level of 25,150. Dollar-rupee exchange rate hovering just below 86. Now then, let's take a closer look at some of the movers. State-owned telecom provider MTNL defaulting in over $1 billion worth of loans. MTNL got those loans issued by 7 public sector banks. The telco's loan default are also expected to add to the government's financial burden and challenges in the highly competitive telecom sector. Vodafone Idea, in which the Indian government owns a 49% stake, has also reported massive losses. However, losses seem to be relatively contained at this level of 49.85 for MTNL. And bad loans also hurting lender HDB Financial Services. First quarter profit dropping. Indian lenders have been under pressure from rising bad loans in recent quarters following a period of aggressive lending, particularly in the unsecured credit segments. HDB Financial had also reported a profit decline in the March quarter due to similar challenges. Despite the pressure, Q1 revenue rose 15% year-on-year. This also marks the company's first earnings report since its trading debut earlier this month. The stock down by 2%. More earnings. ICICI Lombard posted a near 29% rise in first quarter profit, driven by strong premium income in retail insurance and motor segments. Retail and corporate health insurance premiums jumped 44% and 10% respectively from a year ago, while motor premiums rose 13.5%. Demand for health insurance has surged in India due to rising medical costs and greater awareness, particularly in the wake of the COVID pandemic. The stock up by 0.3%. Right, that's all the time that we have today on this Wednesday edition of Inside India. Do keep watching CNBC. Access Middle East with Dan Murphy is coming up next.